There's a chart that predicted the Wall Street crash 54 years before it happened. This chart also called the top of the dot-com bubble in 1999, the 2008 financial crash, even COVID. And it was made by a pig farmer in Ohio with zero financial education who had just lost everything. Now, look, I know this sounds like clickbait. Can a chart from 1875 actually predict the stock market in 2026? Here's the thing. I've been doing quantitative market analysis since 1999. I'm a data-focused investor, not a guy who typically gets excited about a 150-year-old chart from a pig farmer. But with this chart is showing for 2026 happens to line up almost exactly with my quantitative models. So I thought, you know what? Let's have some fun with this. Let's use this historical framework as a lens to examine what's actually happening in the market right now based upon the real data. In this video, I'll introduce you to this mystery chart from the 1800s and the powerful lessons I can teach you about market cycles that can benefit your portfolio in the short and long term. But first, who am I? I'm Steve Reitmeister. I've been investing for over 4 decades. I'm the former editor-in-chief at Zacks.com and a current partner at Wall Street Zen, where I helped develop a quant rating system to help investors find great stocks fast without all the noise. Before we jump in, if you're interested in topics like this, please give this video a like. It tells me what kind of themes that you enjoy so I can make more videos like this in the future. On to the topic at hand. That mystery chart I discussed earlier is called the Benner cycle. To truly understand it, we have to go all the way back to 1873 in Ohio. Here we have a pig farmer named Samuel Benner, and by all accounts, he's pretty successful at what he does. Things are chugging along for him until the panic of 1873. Picture the 2008 financial crisis, but instead of being the housing market, it was triggered by a combination of bank failures, currency changes, and railroad speculation. What happened? Benner lost everything. Most people would just lick their wounds and move on, but Benner got obsessed. He spent years analyzing market patterns, the price of hogs, corn, iron, just about everything to try and find cycles that could help others properly time when to buy and when to sell. In 1875, he published Benner's prophecies on futures ups and downs in prices. It included this hand-drawn chart forecasting market highs and lows using the 3 different patterns. Pattern 1, prosperity, followed a 16, 18, and 20-year cycle. Number 2, commodity lows followed an 8, 9, 10-year cycle. And number 3, recessions followed 5, 6, and 7-year cycles. One small detail before we move on. When you see Benner mark a year like 1857 or 1873, he means the end of that year, not the beginning. Okay, Benner's original chart only went to 1891, but later another forecaster named George Trich extended it all the way to 2059 and added another layer of detail with buy and sell zones marked with the letters A, B, and C. Okay, this chart has 2 cycles. First, a major cycle for long-term market movements marked by a thick brown or yellowish line. The second cycle tracks shorter-term moves marked by a thinner gray line. So that's the framework in a nutshell. A pig farmer who lost everything spent years finding price patterns to create this market cycle chart. But here's where it gets interesting. Before I continue, a quick aside. I don't actually think this chart has magical predictive powers. Markets are complex, adaptive systems with thousands of variables involved. The idea that a pig farmer in 1875, or anyone for that matter, will create a portfolio that works forever, simply not going to happen. But, and this is a big but, this chart has some really notable alignments with major market turning points. And I think studying why these alignments happen can teach us something worthwhile about market cycles. Now let's look at the track record. First up, the Great Depression alignment. In the extended version of the chart, 1927 was flagged as a potential cycle top. That's close enough to the final famed crash of 1929 that kicked off the Great Depression. But was that really a solid prediction or just a stroke of luck? Next up, we have the dot-com bubble, and sure enough, 1999 is also marked as a year in the A zone, which denotes a cycle high preceding a panic. In other words, the optimal time to sell. The dot-com bubble burst shortly afterwards. Coincidence, or was Benner's pattern actually tracking something real about how long-term bull markets tend to run before euphoria peaks? Now let's talk about the 2008 financial crisis. 2007 was a B zone, a sell signal that marks the top of a short-term cycle. The 2008 financial crash follows closely behind. Again, was this a prediction or coincidence? The chart even puts 2019 in the panic selling category, and soon after 2019 ended, what happened? COVID hit. There's no cycle chart that can predict a pandemic like COVID. That's not even up for discussion, but we're still left with something that looks fairly legitimate, right? Here's what I find generally interesting. Setting aside the question of whether this is predictive for a moment, this chart definitely captures something real, and that's the cyclical nature of markets. Bull markets don't last forever. Credit expansions lead to credit contractions. Periods of euphoria are followed by periods of panic. Human psychology moves in waves, and these waves tend to have certain amounts of time to play out. I don't think Benner had a crystal ball, but I do think he observed something true about market cycles, and that's certainly worth understanding. Okay, so let's talk about what Brenner's framework says about the 2026 stock market and why you should know about it. But first, a reminder that if you want to be the first to know when I release more videos like this one, you got to hit that subscribe button down below. Okay, so here's the good news. According to the pattern, we're in a favorable period that runs through late 2026, the expansion phase. That means rising prices and market strength. Then, at the end of 2026, the framework suggests a potential transition. This is to be followed by a more challenging period that should last all the way up to 2032. By the way, this is a topic I covered in great detail in my most recent video about Vanguard's market predictions for 2026 and beyond. The link to that video is in the description below. This is where the chart gets interesting for me, because when I look at what the actual quantitative data is telling me, the real fundamentals, the real valuations, the real economic indicators, I'm seeing something quite similar. I find it generally interesting that this 150-year-old cyclical framework actually aligns with what the modern data is showing me. So let me show you what the actual data says about 2026. First, yes, the bull market likely continues through 2026. Remember that the average bull market lasts 63 months, while we're only 39 months from the October 2022 lows. Plenty of time left on the clock for this bull market to continue. The economy is doing fine, about 2% GDP growth, plus the Fed is cutting rates, right? Don't fight the Fed. And earnings growth for the S&P 500 is projected about 8% a year for the year ahead. Okay, 85 to 90% of our lifetime has been spent in bull markets. That's the base case, meaning it's a bull market till proven otherwise. But it's not all good news. Both Benner's cycle framework and the current fundamental data are showing some of the same warning signs. Warning sign number one, valuations. We're showing late cycle valuation characteristics like the mega caps, your Magnificent Seven, are trading at PEs around 30. That's higher than any time in history for that group. Historically, their PE is more in the high teens to low 20s. Large caps overall, their PE is about 22. The only other time we've been in that range is just before the bursting of the tech bubble in 2000. The AI stock boom has that same "this time is different" and valuation don't matter energy as that late 90s tech bubble. And we all remember how poorly that cycle ended. This is a classic late cycle behavior. Feels a bit too much like late 1998 or early 1999 to me. Valuations are certainly getting stretched, but we haven't reached the peak mania levels yet, which means maybe more frothy upside to come, or maybe investors have learned their lessons of history and will start to cool off on these stocks. We shall see. Warning sign number two, employment is weakening, another late cycle indicator. Quite some time we have been adding fewer than 150,000 jobs per month. That means we are below the threshold needed just to keep up with population growth, which is why the unemployment rate is starting to trickle higher. Why? For one, uncertainty over tariffs. When businesses don't know what's happening with trade policy, they press pause on many things like expansions, investments, and yes, hiring. And here's the cycle dynamic. What creates recessions? Well, lower spending. What causes lower spending? Actual job loss and the fear of losing one's job in the future. This is how late cycle expansions typically come to an end. Warning sign number three, shift in stock leadership. For the past few years, the mega cap tech stocks have been driving the market higher. They've been the unquestioned leaders, a near easy button for investors. But when those stocks get too expensive and their growth rates slow, new stocks have to take over the leadership. That transition creates confusion, sector rotations, and hefty volatility. 2026 won't likely be another year of just buying mega caps and watching them go up 25% or more. The easy button trades are over. That's because small and big caps are trading for 30 to 40% below their large cap peers. That's a massive disconnect, which should lead to rotation to these smaller, more undervalued names. This is another classic late cycle pattern. The stocks that led the bull market get overvalued. Smart money starts rotating to cheaper alternatives. Volatility volatility picks up. So here's what's fascinating. Benner's framework says potential transition at the end of 2026. My fundamental data says late cycle characteristics, leadership shift coming, increased volatility ahead. Once again, it's interesting that a model from way back in 1875 is pointing to the same conditions that current data is flagging, meaning it strongly should suggest that there is something real and valuable about these long-term market cycles. Not that we can predict the timing precisely, but that they exist. And learning to recognize late cycle characteristics is quite valuable. Okay, real quick, let me show you the minor cycles in Benner's chart, the thinner gray lines tracking the short-term moves. Benner observed this pattern. 2 years positive equals 5 years negative. 3 years positive equals 6 years negative. 4 years positive equals 7 years negative. Now again, I don't think this is absolutely predictive, but what it does teach us is equally valuable. Bull markets don't go straight up. Even in strong uptrends, you get meaningful pullbacks, corrections, and consolidations. For example, the Benner framework suggested caution in the late 1920s, which happened to align pretty well with the timing of the 1929 crash. 1996 to 1999 was projected as bullish leading up to a peak at the end of 1999. Matches up well with the dot-com top. End of 2007 pointed to a transition, which aligned well with the 2008 financial crisis. The lesson isn't Benner can predict crashes. The lesson is markets have short-term rhythms with longer-term trends. Understanding that helps us avoid panic selling at bottoms or euphoric buying at tops. With this in mind, you expect volatility, you expect pullbacks, and most importantly, you don't get shaken out when normal cyclical corrections take place. So let's pull back. What's actually valuable about studying Benner's framework? Lesson number one, it reinforces that markets are inherently cyclical. Credit cycles, business cycles, sentiment cycles, they're real. You can't time them perfectly, but understanding you're in a cycle can help you prepare your portfolio. Lesson number two, it teaches us about human psychology patterns, fear and greed, euphoria and panic, FOMO and capitulation. These emotions drive markets in waves. Every generation thinks this time is different. It never is. Lesson number three, it shows us the danger of precise predictions. Even when Benner's framework aligned with reality, the time was often off by years. The lesson, cycles exist, but exact timing is impossible. Thus, wise to position for the cycle, but don't bet everything on the precise dates. So what do we know? Small caps have an advantage over large cap. Valuations for mega caps and AI are a bad idea. We're also looking for solid fundamentals, and luckily there's a solution. In my exclusive Zen investor portfolio, I've leveraged our powerful quant model to narrow down the search. Then I handpicked the stocks I'm most confident in given all the lessons learned in my 45-year investing career. We track 4,600 stocks at Wall Street Zen. Then I narrowed that down to the top 20 stocks in my Zen investor portfolio. If you'd like to see those 20 stocks, then check out the link in the description below. Lesson number four, it's a perfect example of survivorship bias. We remember when the framework aligned with reality, we sometimes forget when it didn't. Now here's a little homework for you. Pull up the Benner chart and look at what it says about the year 1969. Then go to Google, read about what happened in the economy and the stock market in 1969. Any illusions that Benner was somehow predicting the future will quickly wither away. This teaches us to be skeptical about any single predictive system. The point isn't this chart predicts the future. The point is markets move in cycles, and learning to recognize where we are in a cycle based upon the actual data helps inform better investing decisions. So what do we actually do with this information? Whether you think Benner's cycle framework has merit or you think it's total nonsense, both the cycle framework and the real fundamental data are suggesting that 2026 is a late cycle transitional year. That means you need to position differently than you would if you were earlier in the bull market cycle. So here's my strategic approach, and this is based on the current fundamentals, not fortune telling. Strategy number one, quality over hype. Late cycle means that valuations are getting stretched with a potential top ahead. This is not the time to chase overvalued AI stocks with 100 plus PEs. Focus on fundamentally sound companies with consistent earnings growth and reasonable valuations. The sometimes boring stuff that actually matters and actually pays off. Strategy number two, position for the leadership rotation. The data is clear. Small and mid cap stocks are 30 to 40% undervalued relative to large caps, while mega caps are beyond stretched. When market leadership rotates, you want to be positioned in the new leaders, not the old ones. But not just any small cap. You want the ones with strong fundamentals, consistent growth, and momentum starting to shift in their favor. This is where quantitative selection becomes critical. You need to filter down from the thousands of possible stocks to the ones actually positioned to lead the next phase. Easiest place to start, our small cap stock screener. scanner. The default settings screen for companies that have a solid growth trajectory, as well as revenue growth that outpaces both the market and the ticker-specific industry. The link for the screener is in the description. Strategy 3, buy the discipline. If 2026 is going to be volatile, with sector rotations and leadership changes, with both cycle theory and fundamental data suggesting this, then the best strategy is buying quality stocks when they get temporarily roughed up. This is the time-honored solution for volatile bull markets. Wait for quality stocks to dip during corrections, buy them at better prices, watch them bounce back. We built a specific model for this at Wall Street Zen called the buy the dip strategy. It's part of our Zen strategy service with an average annual return of 36% a year going back to 2003. In November 2025 alone, it returned a stellar 22.6%. I'll put the link in the description below so you can go and check it out for yourself. I trade the buy the dip strategy in my Schwab account. Gladly, it generated a real-life 56.5% return over the last 5 months, making over $70,000 on a $125,000 account. I show my actual brokerage statements because I believe in full transparency. Too many people in this industry make claims that don't match reality. Strategy number 4, multi-factor systemic selection. This is where my quant investing background comes in handy. You can't just pick stocks based on a single factor. Oh, it's cheap, or it's growing, or it has momentum. You need to evaluate stocks across multiple dimensions. Financial strength. Can it survive if the cycle turns? Growth consistency. Real sustainable growth. Momentum. Is it actually starting to move? Valuation. Are you paying too much? Sentiment. Is the smart money on board? This is what you get with the Zen ratings. 115 different factors evaluated for every stock, including financials, growth, momentum, value, sentiment, and more. In the past, our model has identified 407 different stocks that have doubled in price or more. Right now, we have a special report that pinpoints 3 more stocks with that same kind of exciting upside potential. The link to this free report with those 3 stocks to double is in the description below. Because whether you're late cycle or not, whether Benner is right or wrong, systemic selection based upon multiple factors is what actually outperforms over time. Before we go, here's the critical mistake I see far too many investors making. They see a prediction or a cycle framework and they base their entire strategy on that one thing. Like Benner says the top is in 2026, so I'm going all in on whatever's hot. Both ideas are an outright disaster. Neither of the 2 approaches can account for geopolitical shocks, policy changes, technology disruptions, black swan events. All right, let me bring this one home. Is the Benner cycle a magical prediction tool? No. Can a pig farmer from the 1875 tell you exactly what will happen in 2026? Of course not. But it does reinforce something important. Markets do move in cycles, and learning to recognize late cycle characteristics, stretched valuations, weakening employment, leadership rotations, that's valuable regardless of what any chart says. Cycle frameworks like Benner's are fun to study. They teach us about market patterns and psychology, but they're educational tools, not trading system. What actually makes money? Discipline, systemic investing based upon multiple fundamental factors. The key takeaway, study cycles to understand context, but invest based upon the current fundamentals. That's what works. Hey, let me know your thoughts in the comments section below. Like, do you think there's anything to these historical cycle patterns, or is it all just confirmation bias? I'm curious to hear what you think. And if you're interested in more near-term market predictions, I highly recommend you check out my video about Vanguard's market predictions for 2026 and beyond.